look at the figure 6.2. With respect to the value creating diversification strategies that we talked just before, the strategy can be segmented into 4 types of strategies based on the levels of operational relatedness, that is, the extent to which firms share activities among businesses, and the levels of corporate relatedness, that is, the extent to which firms transfer skills or core competencies into businesses through corporate headquarters. So there are related constraint diversification strategy, related linked diversification strategy, both operational and corporate level corporate relatedness strategy, and unrelated diversification strategy. First, we look at how firms create value by related diversification strategies. Typically, the related diversification is used to increase the firm's value by economies of scope, more specifically by sharing activities or by transferring skills and core competencies through headquarters among their businesses. A firm may focus on sharing primary or supporting activities, or the other firm may focus on corporate relatedness, that is, transferring their core competencies in managerial and technological knowledge, experience, or expertise. The difference between operational relatedness and corporate relatedness is based on how separate resources are jointly used to create economies of scope. In other words, tangible resources or less tangible resources such as patented technology or manufacturing process can be shared, while know-how embedded in separated activities in different functional units is a transfer of a core of the corporate level core competencies. Firms also use related diversification strategy to gain market power. Market power exists when the firm sells more above competitive level or reduce the cost below the competitive level. So firms that share activities easily reduce related cost so that increase market power. Also, firms gain market power by multi-point competition because extending and first moving at different markets increase market power by blocking competitors and building entry barriers. Furthermore, firms gain market power by vertical integration. By integrating either backward units for more input level related or forward units for output related, such as distribution or delivery system, firm may reduce possible market cost. Simultaneous operational relatedness and corporate relatedness diversification strategy is difficult to imitate by competitors, but it is hard to implement due to the higher cost. If the cost is not offset by the benefits, the firm becomes in difficulty. Please analyze the opening case again in terms of simultaneous operational relatedness and corporate relatedness diversification strategy. Now we talk about unrelated diversification strategy. Firms can create the value by unrelated diversification strategy by realizing financial economies. This is like stock investment. If a firm has more unrelated businesses, the firm allocate their internal capital into different businesses based on their risk level or expected performance, or purchase other corporations' assets, restructure, and sell it in the external market. Let's remind value neutral reason for diversification again. A firm uses corporate level diversification strategies to neutralize a competitor's market power or any possible negative factors. There are incentives and resources that encourage diversification, as it is an external environment that gives a firm an incentive to diversify. Government antitrust law basically discourage merger and acquisition, especially major mergers that create monopoly or oligopolistic power. The antitrust law emerged and enforced the mergers in 1960s, 70s, and early 2000s due to the unbalanced market power. The other external environment is higher tax law. High tax rates push a firm shift to buy and build other firms in high performance industries or countries. 1986 Tax Reform Act is one of the example of government policy change that create incentives to firms and shareholders. Low performance as one of the internal environments is highly related to the incentives of diversification. Some research in strategy shows that low returns are highly related to greater levels of diversification because high performance eliminates the need for greater diversification. In other words, as it is shown in the figure. In addition, if a firm and its product line becomes mature and threatened, or if a firm is small and is in mature industry, sometimes it is necessary to diversify for long-term survival. At last, for the purpose of synergy and firm risk reduction, firms have incentives to diversify. But most of all, if a firm successfully needs to diversify, the firm must have both proper reason and incentives to diversify, as well as the sufficient resources required, such as cash and tangible resources. Finally, we talk about value-reducing diversification strategy. Managerial motives, the motives such as managerial risk reduction, desire for increased compensation, and build personal performance reputation lead managers sometimes over-diversify. The effects of inadequate over-diversification are the failure to earn above average return or threat of hostile takeover by other firms. Today we learned corporate level strategy, which could be a little bit complicated. This figure provides a summary and overview of the relationship between diversification and firm performance. If you have further questions, please contact me. Thank you again, and don't forget case discussion and business strategy exercise.